All right. Well, thanks for those questions. I'll keep going because what I really want to dive into is thematic investing, which is this smallish but really rapidly growing portion of not only the ETF world, but of the broader investing world. It's kind of the birth of an entirely new way of thinking about investing. And it's something that we have really developed very thoroughly at GlobalX, especially from a research perspective. So just a couple more stats on GlobalX. You can see our assets are actually 43 billion now, and about half of that is coming from our thematic investing suite, where we have 32 ETFs today. We've been doing thematic investing for about 10 or 11 years. So a lot of what I'll talk about seems really new, really innovative, like it just came out a couple of years ago. And in many cases, it has. The growth of thematic investing is a pretty recent acceleration, but thematic investing isn't new. It's actually been around for several decades, and I'll talk about that a little bit more, but we've been doing it for about 11 years. Our very first thematic ETF was a lithium and battery tech ETF that we launched back in 2010. Since then, we've expanded our thematic suite to over 32 products. You can see them all here. A lot of interesting things from artificial intelligence to cannabis to hydrogen ETFs to e-commerce, really kind of covering a broad swath of ideas that we broadly classify as either disruptive technologies, themes driven by people and demographics, themes driven by the physical environment, or even multi-theme ETFs that are combining several themes at once. So what the heck is thematic investing? Very broadly, we talk about disruption a lot in the economy. And frankly, it's not hard to pull any of these stats. The stats you see on this slide, an analyst on our team pulled in about 20 minutes when I said, go find some interesting stats about disruption. You can look at Singles Day in China, which is coming up in 2 days, which absolutely dwarfs Prime Day or Black Friday in the United States. You can look at how Gen Z prefers to spend their leisure time, which is much more likely watching esports or basically video games online versus traditional sports. You can see the number of people and devices connected to the internet, or the rise of cryptocurrencies. I'm already off by a factor of 2 with the cryptocurrency market cap since we created this slide. Disruption is happening really quickly across several parts of the economy. If you look less broadly at just disruption across the economy and look more specifically within sectors, you can see that disruption as well. Within consumer discretionary, how do people spend money? Well, it turns out if you look at a lot of statistics, boomers and even Gen Xers spend their money, their discretionary income, very differently than millennials or Gen Xers. That means people producing items for baby boomers or Gen Xers are probably going to start to suffer when baby boomers retire and wind down their spending, whereas companies that cater to the unique spending preferences of millennials are likely to thrive, whether that means selling more stuff online, selling more experiences rather than luxury items, being more focused on health and wellness or organic foods. There's a lot of things that millennials kind of disproportionately score higher on than other generations. You can look at other sectors. The energy sector. The energy sector right now is basically oil and gas. The energy sector in the future might look nothing like that as we see a transition to renewable energy and electrified transportation. Even the financial sector, dominated by major banks that basically serve as intermediaries for savings and loans and deals, is quickly being disintermediated by fintech and what we were chatting about before this call started, cryptocurrencies that are seeking to really take out banks as the middlemen. So across sectors, you can see disruption is happening very quickly as well. You can go through healthcare and industrials and IT, but disruption is happening basically across all aspects of the economy. That disruption even accelerated in just the last 2 years. You can see some themes like genomics that have completely upended the healthcare space, as we can now do basically personalized and customized medicine based off of someone's individual genome. You can see the growth in robotics and AI with disrupted supply chains as people look to really reorient supply chains and re-domesticate them while reducing costs. Our dependence on cloud computing rather than on-premises computing while we work from home or learn from home, as well as how we spend our leisure time changed as we were all locked indoors and couldn't go to sporting events or concerts or bars. We had to find new ways to entertain ourselves. So basically, we've been seeing a lot of disruption for years. That disruption gets accelerated over the last couple of years due to the pandemic. All of this is kind of a wind up to thinking about how thematic investing fits within a portfolio and how it's different from traditional approaches. Now, this is going to sound a little bit controversial and probably go against a few things that you learn within your Columbia curriculum, but a lot of finance is based off of looking at the past. When you do value investing, a lot of what you're trying to do is mimic returns that people have seen in the past from value. That if you can buy stocks cheap, historically, looking back 20 years, looking back 40 years, that has worked very well. So let's try to identify the cheap stocks now and continue that pattern. Or even let's look at momentum stocks or low volatility stocks or quality stocks, whatever factor that we've measured in the past that tended to outperform, that's great. Let's invest in it in the future. That's all fine. But there's also very likely a future that we can't anticipate, a future that is not going to repeat itself because it's these one-off structural shifts that we have an opportunity to capture. It's playing, if kind of this value investing is a little bit of playing that history repeats itself, thematic investing and anticipating the future is a little bit more like next time will be different. How do we anticipate these changes and incorporate them into our portfolios? I'm not here to say one is better than the other, but I think a lot of finance tends to lean on learning from the past because we have so much data. We have all this pricing data for stocks and for bonds. You can torture that data through different computer algorithms to come up with whatever you want to harvest from that data of what will perform, what we think performed really well in the past and what would perform well in the future. So if we want to just kind of frankly diversify what we're spending our time thinking about and how and what's going to impact our portfolios, it might make sense to not only lean on data from the past, but also lean on anticipating these changes in the future. So a very long wind up for what is thematic investing. It's really a rigorous research-driven approach to harnessing those structural changes around the world. We're trying to identify what are these big macro level trends that are changing huge parts of the global economy. And then from the bottom up, the investing portion of it is what are the companies that stand to benefit from the materialization of those trends. So a few characteristics about this style of investing. It's really designed to be long-term growth-focused strategies. There's some behavioral biases here, which make this very challenging because thematic funds can be very concentrated and see very strong short-term performance, but we really think it's a long-term investment strategy. We don't like to constrain themes by geographies and sectors. In fact, in many ways, geographic classifications and sector classifications, I think, are somewhat broken in the 21st century and aren't really doing a lot of help for investors. So if you throw those away and just say, we want to invest thematically in something like the rise of robotics, why do you care if that robotics company is Japanese, American, or European? Why do you care if that robotics company is classified as an industrials company, a IT company, or even a healthcare company? If it's a leader in robotics from a thematic perspective, we don't care about those classifications. We just care that we're getting good exposure to the companies that benefit from this trend. We also believe thematic investing is best done when it's concentrated. If you're trying to invest in robotics, I'm just going to keep using robotics as an example throughout this presentation. But if you're trying to invest in robotics, this is still a relatively new space, even though robotics have been around since the 1960s and 70s. There's not that many companies in the world that are really pure play robotics companies. So if you're creating a portfolio of 200 stocks investing in robotics, I guarantee you that 200th stock you put in that portfolio is going to have very little to do with robots. We like to be much more concentrated, usually around 35 to 50 names, because that 35th or 50th name is going to be much, much more targeted in the robotics space than the 200th. What makes thematic investing fun and interesting, especially compared to, value investing or any other kind of data heavy, kind of backwards data looking, heavy looking approach, is that these are also relatable concepts. They don't just live in a SQL database. You can see robots in our everyday lives. You might have one cleaning your apartment. You might have autonomous vehicle technology in a newer car that's changing lanes for you or adjusting your speed. This is happening in real life, not just in the world of finance. So what becomes challenging around thematic investing is how do you take a rigorous research-driven approach to identifying themes? On one hand, it's really easy to go out and say robotics is a big theme. Sure, robots are going to get better. They're going to get smarter. They're going to get more capable. Who's not going to buy a robot in the next 10 years? But how do you really take a research-driven approach to investing in robotics and making sure that this is a powerful theme that really warrants investment? Using kind of broad brushstrokes, there's a framework that we use at GlobalX to identify powerful themes that really comes down to three things: conviction, investability, and time horizon. Conviction being, can we study this theme and really develop a basis for why we think this theme is going to disrupt huge parts of the global economy? Usually it can be a technology-driven analysis of what is the state of this technology. Does the technology already work, or is it more pie in the sky? Is it already being sold and monetized? I think that's relevant to the discussion of the metaverse, which has come up several times from really big companies over the last couple of weeks. Is it actually being sold and monetized? What is the adoption of this technology? Are people already using it? Is there a great use case for it, or is it mostly being sold off of hype? Are there other technologies that need to advance to make this technology viable? Again, sorry to pick on the metaverse, but for that to really work, you need AR, VR technology, which is okay and not amazing right now. So we look at a lot of these different things to try to avoid just kind of the hype cycle around technology and really think about what is the adoption of this technology and what state is it. We're also trying to see what is the total addressable market for this technology. But in general, kind of the bigger the total addressable market, the more powerful this theme could be if our conviction really plays out. The second thing we have to look at is investability. So it's fine if you like a theme. Where a lot of themes go to die is that you can't actually invest in it, at least not through public equity markets. So in ETFs, we can only trade publicly traded securities. We're not in private equity. We're not, doing venture capital. Basically, we have to look at publicly traded stocks. That's fine, but that means some themes really can't be invested in. Some themes that other people are peddling, we still think don't even give good exposure to the theme. So we'll keep this between us, but some of our competitors have space ETFs. I think it has terrible investability from how we've reviewed it. How are you getting pure play exposure to the space theme? You get to invest in Virgin Galactic, and that's it. They have to fill up their portfolio with 25 other stocks. They're throwing in stuff like Garmin because it uses satellites. They're throwing in Northrop Grumman because they have a few space-related technologies. But as a percentage of the revenue of those companies, they're really not providing exposure to space. The funniest thing I've seen in a space ETF is Netflix and John Deere. I don't know how other companies got comfortable with that from an investability perspective, but they decided that those two companies somehow are a part of the space theme. When we look at our themes, we really want pure play exposure, the companies that are really involved in developing a theme going forward, not this tangential exposure.
And Jay, I used to cover John Deere when I worked in capital markets years ago. And I think they're in there because their tractors and farm equipment are GPS and satellite driven and operated. So,
there you go.
There you go.
I thought it had to do with terraforming Mars and we were going to build outposts out there with the tractors. But either way, revenue related to space. Netflix was the funnier one because I think the theory behind that is if you're flying to Mars, you have a lot of time to kill. And so astronauts are going to be watching a ton of Netflix. Again, I don't understand how that's going to be a big part of their revenue. But it's a real challenge with investability. And frankly, throw out GlobalX, just purely if you're thinking about thematic investing on your own, don't just look at the name of an ETF, really look under the hood at what's in it, what it's investing in. That's one of the great things about ETFs is that transparency, because you will get very different portfolios based off of that investability criteria. A stat for everyone, there's about 6 robotics ETFs in the US today. The average overlap between those 6 ETFs is about 17%. So they all say they're investing in robots, but the portfolios are completely different. There's actually higher overlap. This is my favorite stat. There's higher overlap between the Vanguard Value ETF and the Vanguard Growth ETF than there is between the average 2 robotics ETFs in the US. Go figure. But that's how much kind of discretion there is in thematic investing when you're trying to determine how to get that underlying exposure. Now, finally, time horizon. We really want these themes to be long-term. Part of it, frankly, is a little bit selfish. If we're going to spend 6 to 12 months developing a theme, doing all that R&D, creating a fund, launching that fund, and talking to investors about it, if that theme is going to be over in a year, that was a lot of time spent for a theme that's going to be over pretty quickly. Shorter term themes are also a lot less predictable. They can come and go obviously very quickly. It puts a lot of emphasis on the timing of entering and exiting that investment. That's just not the game that we want to be in. We're not trying to time buys and sells very quickly. We want to get in early in a theme in the first few years of it. We want to get out of a theme in the last few years of it. But if we're looking over the course of a decade, it takes a lot of that emphasis away from entry and exit points and really trying to fine tune the timing of a trade. So when you put all 3 of those things together, conviction, investability, and time horizon, you end up with roughly the 30 or so themes that we've identified and brought out in ETFs today. To give a sense of how many get screened out, we've identified about 75 or 80 themes total. So less than half of them, really pass these three tests. This just kind of goes a little bit into how we determine the conviction of a theme. I already talked about this a little bit, but the total addressable market, what is the speed of the adoption? How is it being commercialized? When we're researching it, what are the sources we're looking at? Not a lot of great aggregators for this stuff. So oftentimes we're talking to companies themselves, going to conferences like CES, where we're trying to kind of play around with the technology in person. We try to use alternative data providers, but really trying to get that research behind these themes is where a lot of our innovation comes in, because it's unfortunately not a lot of companies report their revenue as the way we want them to in a theme. A robotics company doesn't just report their revenue as robotics. If you go to look at Mitsubishi Electric, big industrial automation company, unfortunately, they report their robotics revenue as industrial machinery, and it's not really clear how much of that industrial machinery is really robots versus non-robots. So a lot of research has to happen on the back end to determine kind of our conviction behind the theme and try to figure out what's happening with the companies within the theme. I also talked about kind of investability already, the focus on finding those pure plays, but a lot of work happens in just trying to identify the segments themselves. So once you've decided that robots is a really cool theme, what's the next step down? What is robots? What is the kind of investable universe for robotics companies? Are you investing in autonomous vehicles? Are you investing in drones? Are you investing in industrial robots, non-industrial robots? Do you go upstream into the components that robotics companies are buying? You can invest in the ball bearing companies that put the ball bearings in the robotic arms, but is that, do you want that exposure? Do you want the really downstream exposure of the artificial intelligence developers that is creating the software that goes into robotics? So there's a lot of questions around kind of scoping just the various segments you want to get exposure to before you go down to the company level and try to identify the companies that are really deriving the majority of their revenue from that theme. I'll also point out something here, because I mentioned ARK ETFs and Cathie Wood, because I think many of you, if you spend any time on Reddit in the investing world, you've probably come across Cathie Wood and ARK. She's kind of a cult hero these days. There's a fundamental difference in how we're doing thematic investing and how active managers are doing it. Active managers are trying to make two bets. They're trying to bet that one, the theme will materialize, and two, the stocks that they're picking within those themes are going to be the big winners. We're not trying to do that second step. We're not trying to pick the big winners. We're not trying to tell you that NVIDIA or AMD is better positioned in autonomous vehicle chipsets or crypto mining rigs. We're trying to invest in the entire ecosystem and kind of ride the rising tide, not pick winners and losers, but really get that broader exposure. You can really see it both ways. If you get the theme right and the company right, you can see phenomenal returns, as the ARK ETFs have. But you can also get the theme right and the company wrong and not go anywhere when you're watching robotics start to take over the world. So ours is a little bit broader, a little more diversified, a little bit less volatile in many ways, trying to play kind of the rising ecosystem. I talked a little bit about time horizon as well. It's easy to get caught up with cyclical themes rather than structural ones. Cyclical themes being kind of represented by that blue wave. Cyclical themes come and go. People in the media talk about the theme of growth over value, or the theme of defensives over cyclicals, or the theme of changing currencies. If you want to use a broad definition of themes, that's fine, but those are going to be cyclical themes that are going to come and go and probably mean revert, rather than structural themes that are really these one-off paradigm shifts. We're looking for those one-off paradigm shifts because it doesn't depend on timing. Cyclical themes, you can make a ton of money, but you have to be buying at the trough and selling at the peak.
AJ, can I ask you a question about sort of that chart? Solidified it in my mind. Like, how do you measure success? So you have a picture of your structural theme growing. Is your expectation that, the stock prices are growing at the same rate as the theme? How much do you worry about, stocks have already anticipated X% of this growth? What, I guess, relationship do you expect to see between the performance of the fund and the theme by whatever measure of the theme you have that measures how prevalent it's become?
Yeah, it's a great question. So that S curve, the structural theme, really translates into the adoption curve. Kind of came up with E.M. Rogers. You've probably studied, the P's and Q's of the Bass model. The Bass model is basically, the formula that determines the shape of an S curve of adopting a new technology or a new product. But you can plot basically any theme along the S curve, where the further to the left a theme is, the lower the adoption and kind of the bigger the opportunity. The further to the right, the more adopted a theme already is, but it's already kind of penetrated its total addressable market. So every theme is going to have a different S-shaped pattern of where it is on adoption, usually starting out slow before it accelerates across the broad market, and then it kind of tapers off as that theme becomes fully played out. So divorcing things from the stock performance question, a lot of what we do in kind of researching our conviction behind a theme is trying to understand where is it on the adoption curve. How early are we in the theme, and what is the total potential that's out there, and how are we going to get from point A to point B? You can see in history, the S curve isn't totally made up. A lot of technologies basically follow that S-shaped pattern of adoption, from color TVs to computers to refrigerators. They start out with that slow initial adoption, and then it starts to accelerate and fully kind of taper off. We've plotted almost all of our themes on the adoption curve here, where you can see kind of how early they are versus how late they are. Harry, I promise I'm getting to your question, but it's kind of a long wind up to get to the answer. It's really easy to get enamored with left side themes because they're early, they're innovative, they're interesting, and it looks like there's a world of opportunity for their adoption. But there's also a lot of risk. Right now, one of our earliest themes is hydrogen. It's basically where lithium and battery technology was 10 years ago. Hydrogen is expensive. There's basically no one really producing hydrogen at scale, definitely not green hydrogen. Most hydrogen right now is created using natural gas, so it's definitely not green. It's called gray hydrogen. And there's kind of this concept that as we develop more renewable energy capacity, excess energy that's not being used, generated by windmills at night or solar panels during the day, that electricity can be used to separate hydrogen from oxygen, basically split water into its components, store that hydrogen. That hydrogen becomes a battery that you could pop into a 18-wheeler, or you could pop it into a ship, or you could pop it into an airplane, and it can use that essentially as fuel to power heavy transport. Really exciting theme, really cool, huge part of the renewable energy landscape. But it's too expensive and no one's really producing it at scale right now. So what do you do with a theme like that? Huge addressable market, almost no penetration. There's a ton of risk and a ton of opportunity. So other people want to be further out, further to the right of the chart. You can look at something like social media. Social media is not going away. 86% of US adults have a social media account. These companies are profitable. They're still growing really quickly. Most companies are reporting basically annual revenue growth of around 20% as an industry. So phenomenal theme with a lot less risk. But at some point, we'll see the growth rates of the Facebooks of the world start to come down. So what we're trying to do, especially when we're developing a portfolio of several themes, is kind of try to optimize across this curve, not just looking only at left-hand side themes, not only just looking at right-hand side themes, not just looking at technology, not just looking at demographics, but trying to kind of find an optimal mix between these themes that's going to give us diversification, that's going to give us themes at different stages of growth, and also will give us some diversification across those traditional ways of thinking about the world, like geographies and sectors. So really long wind up, but I'll skip ahead to a few slides. We get questions about valuations all the time, because effectively going from the S curve to an investment is thinking about not only what is the growth opportunity, but how much of that growth is already priced in. So we often get the question of, are themes expensive? And if you're purely just looking at themes based off of traditional valuation metrics, of course they're going to look expensive. PE for any theme is probably going to be in the thousands or incalculable, because these companies aren't even generating earnings. That's totally fine. These companies are not trying to be profitable. They're trying to plow, if they're really high growth themes, they're trying to plow every dollar back into growing their business. So instead of looking at price to earnings, we tend to look at things like price to sales, because at least, sales, these companies are trying to generate sales as closely as possible. Sales aligns with the adoption curve. You can see as sales is increasing, they're moving along that adoption curve. But it's still kind of imperfect. You can see the price to sales for, wait, are we showing it here? We're not showing it on this chart. The price to sales of a lot of themes is like 8x, 10x. I think the price to sales for cannabis companies is like 25x right now. based off of traditional ways of thinking about things, that's definitely not value. These are definitely not value stocks, and they don't even chart if you're looking at them, relative to the S&P 500 or even the NASDAQ 100. But really, the bigger question is, how much of that growth is priced into the stock? One way you can look at that, or into the theme. One way you can look at that is try to normalize the valuations by growth. So people might look at a PEG ratio, price to earnings to growth, but we know these companies are not trying to generate profits. So you can look at price to sales to growth or EV sales to growth, just to try to kind of normalize a kind of fixed valuation with what is the anticipated growth of that theme. Another way to think about it, though, is really just kind of trying to project forward future cash flows, right? A DCF model. In a vacuum, a price to sales of 10 might seem really expensive for a theme. That theme might be genomics, where a lot of companies in the genomic space are developing revolutionary drugs and basically have no sales today. It's actually fully possible that genomics companies could grow their revenue 100% year over year for 5 years going forward as a drug gets approved by the FDA, approved by foreign versions of the FDA, and they start to train and sell their drugs to doctors. So if you're looking at a price to sales today of 10, and they're going to see 100% year over year growth for 5 years, that price to sales actually looks pretty cheap if they can actually realize that. And a lot of themes, we see that that's basically true, that if they can sustain high growth for several years, the valuations are not that expensive. Now, they're not going to be cheap in absolute terms, but what you're really betting on is that this theme is very powerful and is going to continue for a long time. This takes me back to this slide that we kind of skipped over. What is kind of the structural benefit to thematic investing? Because it might seem really easy, again, to invest in robotics or invest in genomics. These aren't groundbreaking ideas. People have thought about this stuff. We're not the only people in the market to be thinking, oh, genomics is an interesting theme. Why is there a reason that investing in genomics should outperform the market over the long run? One of them is more behavioral, just embrace the long-term mindset. People tend to be shorter term in nature. I saw that in 2020, I think it was in June, was the shortest Reuters has ever measured the average holding period in the US stock market at about 5.5 months. Even before the pandemic, average holding periods were about 9 months. So you can really think for long-term compounding growth, looking out 10 years, 15 years, it's just a behavioral advantage more than anything, sticking with a theme for the long term. Participating in that exponential growth over the long term, increasingly, but given kind of the size and importance of indexes, a lot of what thematic investing is doing is getting exposure to industries or companies that are very poorly represented in broad indexes today. Meaning, how much robotics exposure are you getting by investing in the S&P 500? About 2%. How much lithium and battery tech exposure are you getting in the S&P 500? About 3% right now, and it's basically just because of Tesla. So a lot of these themes, as they grow and as they get more accepted by the broader market, end up being included in these broader indexes that have, at this point, trillions of dollars tracking them. We also look at kind of diversifying returns. These are more concentrated approaches that are unconstrained. So there's kind of this diversification aspect. There's also a risk-based aspect to thematic investing, which is that in a lot of parts of people's portfolios, you might be overexposed to parts of the economy that are probably going to be destroyed over the next 10 years. If you are a value investor, there's a good chance you have a lot of energy in your portfolio, a lot of traditional oil and gas companies. Do you want to be only invested in oil and gas, knowing that electric cars are on the rise? If you ask Saudi Arabia and if you ask Norway, what are they investing in? They're investing in renewable energy at their public pension fund levels, or their kind of nationalized investment funds. So they're doing this themselves. They're seeing that they have too much exposure to one part of the economy. They're investing in the disruptors. So other people can think about thematic investing in a similar light. Another structural reason, though, that I think is pretty interesting, and I'd be curious to kind of pick the brains of the accounting professors at Columbia, but another reason that kind of benefits these thematic companies in a lot of ways is that R&D is expensed and not capitalized. So companies that are trying to be profitable are shying away from more R&D because they're trying to be profitable. Whereas if you capitalized R&D, it would be recognized more as an investment. And so naturally, this kind of creates a bit of a a bit of a kind of dispersion between companies that are trying to be profitable and how much they're thinking about R&D versus companies that are in that growth mode, not expected to be profitable and can invest more in that R&D. Kind of accelerates some of that disruption in some of these small cap growth companies. So one of the things, I know we're cruising along here, and I should probably pause for a few questions. So I'll kind of show a few more slides here. But one of the challenges of thematic investing is that this is pretty new and it doesn't fit into the traditional structure of thinking about how to classify funds or how to classify investment strategies. One of my favorite things is a robotics fund is classified by Morningstar as miscellaneous other. They literally didn't have a category for robotics and they don't know where to put it. Most funds get put in, large cap core, alt cap value. They have all their categories for it. Thematic investing, they literally throw up their hands and put it in a miscellaneous bucket. That's because we're not thinking about traditional financial frameworks here. We don't care if it's value or growth. Some themes are actually value oriented. We don't care if it's US, international. We don't care if it fits within a sector. We're just trying to invest in the themes that we see the most kind of conviction, time horizon, and investability in. So we actually had to create our own classification system for what to do with all these themes and how they fit in with each other. So we created kind of a 4-tier system. It's a little bit modeled after what Morningstar does for their other classification systems, but it's more applied to themes. Since then, we've seen Morningstar come out with a very similar classification system for themes. So we'll pat ourselves on the back for being early there. But this is just trying to get kind of a scope of what are all the different themes out there and how do they fit in with each other. And we're updating this every single quarter. You can also see the growth of thematic ETFs. So since the beginning of the pandemic, there was only about 27 billion tracking thematic ETFs in the US. Now it's about 5x to 133 billion. And the number of products has basically doubled to about 200 ETFs in the thematic space. A lot of that coming from disruptive technology related themes like cybersecurity and robotics and electric vehicles, but we're also seeing growth across people and demographics and more environmental related themes. Maybe I'll end with one more slide here and then I'll open it up to more questions. But because thematic investing doesn't really fit in traditional financial structures, how do you fit it into a portfolio? It's not always the easiest thing for people to fit in a robotics fund into a portfolio that's owning Vanguard ETFs. What do you sell? If you're going to add it to a portfolio, you're reducing your allocation to one thing or several things to make room for it. One way that we see people do it, if they have a more sector-based approach to investing, is to replace some of their sector exposures with the themes that are disrupting it. So selling out of healthcare and buying genomics, or selling out of financials and buying fintech, selling out of energy and buying lithium and battery technology. But a lot of people aren't necessarily doing sector-based portfolios. So a more common approach is looking at it from a more core satellite way of allocation. So if you have a 60-40 portfolio, maybe it's 60% equities, 30% fixed income, 10% alternatives. People are carving out a portion of that equity sleeve because themes are almost solely equities, although increasingly also crypto. And they're allocating a portion of that equity exposure to themes. The reason why they're kind of carving out a piece of it is because the behavior of that part of the portfolio and how you kind of measure its success is going to be very different than your core funds. Core funds, you want great risk-adjusted returns, you want low expense ratios, you generally probably want low tracking error to broad market benchmarks. Thematic funds are going to be more expensive, they're going to be more volatile, you're going to have huge tracking error in a given year. But that's okay because you're a long-term investor waiting for kind of that compounding growth over time. You don't really care. You shouldn't really care about tracking error in a given year for a theme if you plan on investing in it for 10 years. So again, it's a little bit of a behavioral trick of thinking about how to fit it in a portfolio, but carving out that satellite where you might put 2, 3, or 4 themes and just let it, let that part of the portfolio be buy and hold for a decade. That's one way that people kind of reconcile incorporating it into a broader portfolio. So I'll kind of hit the pause button there so I don't keep talking forever here and see if there's any questions on kind of any of that.
I have a question. Can everyone hear me?
Uh-huh.
earlier on one of the slides, something about alternative medicine was mentioned as one of the themes that the company, so under health, alternative medicine. Who is, I guess, the ideal clientele, and what kind of stocks or equities even go into one of those themes? Because if you're projecting future expectation, alternative medicine is not necessarily the most scientific. So how do you determine like the long-term growth potential of those kind of things?
Yeah, that's what our compliance got comfortable with for psychedelics. It's a really early theme. We've seen we've seen an ETF in Canada and an ETF in the US. So this is kind of capturing the entire ETF ecosystem, specifically trying to track psychedelic stocks that are being used in healthcare. As far as themes go, we haven't brought it out. The investability is pretty poor. The investment case for these companies is interesting. It's going to depend a lot on the regulatory landscape. Somewhat similar to cannabis, you could say that, maybe psychedelics is where cannabis was 10 years ago. And we know how the last 10 years have gone, where over 50% of the population in the US by the end of this year will live in a state that has fully legalized cannabis. And we just saw a Republican senator put forward a plan for legalizing it at the federal level, which could actually be huge for federally legalized cannabis because Democrats are on board as well. But that's a theme. If you're going to throw the adoption curve up, is all the way to the left. Tons of risk, investability questions, time horizon could be too long, or at least just indefinite. So alternative medicine was kind of our euphemism that our legal and compliance got comfortable with.
Okay. And out of curiosity, what is the overlap of a theme like millennials and Gen Z with some of the other ones? Presumably there's just a lot of overlap, particularly for that theme with some of the other ones mentioned earlier on, right?
It's a great question. And that's where it gets really hard with the classification. I mean, someone could launch a fund that's blockchain and sharing economy. Like, I don't know why they would do that, but they could. And so what box do you put it in, right? Just like someone could launch a deep value, deep growth fund. And Morningstar is going to have trouble with classifying that as well. So we try to make our themes kind of mutually exclusive and limit the overlap as much as possible. But we know that's not also really the case for several of these themes. Other ones that people have talked about, Industry 4.0. Like Industry 4.0 is kind of like robots, it's the Internet of Things, it's cybersecurity, it's cloud computing. So if you launch an Industry 4.0 theme, what do you do with that? Broadening this out a little bit more towards kind of diversification and our theory around diversification is, at a very basic level, overlap in these themes is important. If you're owning the same stocks in two themes, you should definitely understand that if you're building a portfolio around them. But what's also important is how adjacent are these themes to each other? Is the emergence of one theme going to power or potentially hinder the emergence of another theme? So right now we're seeing that with robotics and the Internet of Things. Robots today are extremely connected devices. They have tons of sensors on them, measuring temperature, measuring vibrations, computer vision that is sensing things, uploading that data into the cloud, processing it via AI before it's being kind of actuated as a movement by that robot. Why does that matter? Well, when you have a supply chain disruption that is limiting the sale of semiconductors from Internet of Things devices, that makes it very hard to complete orders for robots. So this is more of a short-term theme. It doesn't worry us too much in the grand scheme of things about what the trajectory of robotics and AI is. But if someone has a portfolio that's investing in both robotics and AI and the Internet of Things, they've kind of doubled down on this like intersection of smart factories. And if one thing hurts one of those themes, it's going to hurt both of them. Similar with lithium and infrastructure. The latest infrastructure bill from Washington has $7.5 billion allocated to electric vehicle charging infrastructure. That's fantastic. That is going to push lithium forward because the more infrastructure we have for charging, the more consumers are going to be comfortable buying electric vehicles, and that'll create more demand for lithium, and that'll be fantastic. Those two things are tied together. If that infrastructure bill failed, lithium would have been down as well. And not just, kind of in short term, but in the long term, if we never build electric vehicle charging infrastructure, it really could hinder long-term adoption rates of something like electric vehicles. So we definitely kind of think about this, especially when building multi-theme portfolios. How adjacent are these themes to each other? Do we want them to be adjacent or do we not want them to be adjacent? Oftentimes we don't. Millennials specifically is almost a theme of themes. It's e-commerce, it's health and wellness, it's education, it's video games, it's social media. So in some ways, if you buy a millennial theme, you probably could avoid buying 5 other ETFs as well and just kind of get, capture a lot of those things all at once.
I just have a quick question. So going back to your list, it seems like you have it all covered. So what are like the new themes you are working on, or are there any new themes actually?
Yeah, we launched a lot this year, and a lot of what we've been doing is kind of going like down the thematic chart. So like recently we launched solar and wind, but we also had a renewable energy producers ETF. Raise and windy are basically subsegments of our NRG. So you can kind of create ETFs that are like broader or narrower on the thematic chart. I'll just to visualize this a little bit better. We basically launched this with our NRG, and then we launched these as the subcomponents of our NRG. Can't always do that with Investibility because oftentimes these sub themes are too narrow to really get exposure to, but in this case we could. So some of our recent launches have not been kind of particularly innovative in that sense. It's more just kind of slicing and dicing these themes a little bit more. We just launched ag tech, which I think is a really interesting theme. Going back to John Deere, they actually are really a technology company in a lot of ways, just not a rocket ship company. Doing things like cloud, ag clouds, autonomous tractors, precision spraying, a lot of cool stuff happening in the ag tech space. In terms of themes going forward, I guess I can't kind of disclose too much there, but I would say we're always kind of looking at new themes. One of the nice things is that, let's go back to our 3 criteria. What I mentioned is the thing that gets us held up a lot is investability. We like a theme. We think it's really interesting. We have a lot of conviction behind it. We just can't get exposure. What's changing that in many ways is SPACs and direct listings. We have seen so many companies IPO in the last few years, especially really innovative high-tech companies, that is making a lot of themes investable that weren't investable just 2 years ago. That was definitely the case with our blockchain theme, which we've seen both kind of a rising market cap of a lot of the miners as well as IPOs like Coinbase. Suddenly a theme that was interesting, but we can't get exposure to it, is a theme that is doable in the public equity markets. And then I'll kind of ask myself a question, what is kind of like key from a employee perspective on the research side? Like, what are we looking for in candidates in terms of the research behind all this? I mean, hopefully what I've talked about is giving you a sense of kind of the types of things we look for in research, but part of it is kind of being fluent in technology. A lot of our themes are technology based, not all of them. Some of them are demographics, and some of the stuff we're doing a lot more like survey work of consumers to understand more people and demographic trends. But being at least a hobbyist in technology is helpful. A lot of work that we're trying to do going forward is more on the forecasting front. So using BAS models, using Wright's law to kind of predict the trajectory of some of these technologies is really helpful. And frankly, forecasting work, it's hard to get people who are really good at forecasting. I think really good at forecasting in general, that probably doesn't exist, but at least being able to kind of build models that are very justifiable and help kind of illuminate a path to growth for some of these themes, I think is very helpful. And then also combining that with the ability to communicate. At the end of the day, we have these really interesting, rich stories to tell around these themes, and not just kind of living in a spreadsheet around forecasting what the growth of electric vehicles could be, but also being able to communicate that externally, I think has created really kind of our niche in research, that we can kind of walk the walk and talk the talk with research. I think a lot of places, like, they're looking for one or the other. They're just kind of selling a story with no research behind it, or they're so head deep in research, but they can't really explain what's going on. We really have to live in the middle because we're talking to institutions and financial advisors and self-directed retail.
Hey, can I ask a question? As thematic investing rises, like you sort of mentioned this already, like with SPACs. Sorry, it's loud. Are you seeing companies that are like spinning off divisions, like just specifically because they think it hits a theme and there's going to be higher valuation because it can fit into one of these portfolios?
Well, we just saw GE split into 3 today. I don't know if it's really thematic, but I think kind of the end of the conglomerate era is probably well upon us. And if these companies have really valuable subdivisions, they probably will spin it off. I think less from kind of, I think a lot of this probably won't be determined by the companies themselves, but maybe more the regulatory environment. Does the federal government force Amazon to spin out AWS? Does it force Facebook to spin out, WhatsApp or Instagram? That will be kind of, or Google to spin out YouTube. I think that will be the more impactful question about whether we see some of these more kind of technology conglomerate companies spin out these individual divisions. One of the challenges with thematic investing is, again, going back to that investability and that purity question, we have a cloud computing theme. What do you do with Amazon? AWS is the biggest piece of cloud infrastructure on the planet, and yet it's not the majority of Amazon's revenue, but it's probably the majority of Amazon's value. So when you create a methodology around trying to get exposure to a cloud computing theme, you could say, we're going to include it because it's too important not to have. You could say we're not going to include it because it's not the majority of the revenue, or you could find somewhere in the middle and say we're going to have some exposure but limit it. Because if we just market cap weight this portfolio, Amazon's going to be the biggest holding, and we don't really want that if AWS is still a minority of its revenue. I probably set that up in a leading way. We chose option C out of those 3 options for our cloud computing fund, but it really presents a difficult option. And frankly, when we see spinouts, we get pretty excited because it gives us better purity to the theme. A recent one that probably no one knows or has heard of, FMC, big soil and potash company, spun out Livent, which is a pure play lithium miner. We were so excited about that. One of the biggest lithium miners in the world finally got kind of unlocked from this old industrial soil company so that we could invest in just the lithium operations. That was pretty exciting, but that's only from kind of a nerdy thematic perspective. And yeah, they totally did it because they got a better valuation on Livent than holding it at the parent company. Any other questions? If you guys are interested, I'm happy to send everyone kind of this deck. We got through about 20 of the 100 slides, 150 slides in this deck. If you want to really go into these themes, we do. We have a lot of charts. I guess the other thing we look for in employees is developing a good chart because we got a lot of them. But I really appreciate everyone's time listening to my thematic update here. Keep an eye out as you read the Wall Street Journal, you read Barron's, you read research, keep an eye out for thematic investing. Thematic assets, I may have said this already, thematic assets as a percentage of the total ETF industry is only 2% right now. So if you were to chart thematic investing on the adoption curve, we'd still be in the innovators phase, very early in the adoption of thematic across portfolios. But the conversations we're having with true institutions, family offices, private banks, JP Morgan, Bank of America just allocated to several themes in their big home office portfolios. What financial advisors are doing to bring themes to their clients, what retail investors are doing through Robinhood, it's definitely still very early in thematic investing. And I expect a lot more adoption going forward. It looks like maybe we have one more question from Erin.
Oh, yeah, I have a quick question.
Yeah.
You listed 2 trends for the ETF. One is the thematic investing and the other is ESG. So I wonder if ESG is not included in the thematic investing, or do you have different approach for that for ESG? Yeah, thank you.
Yeah, that's a wonderful question. So I kind of think about it as like a Venn diagram. Sorry for all the chart. For all the slide changing here. I think about it as like a Venn diagram. You have thematic investing, you have sustainable investing, and there's a little bit of overlap in the middle, which is a lot of these physical environment themes. Clean water, clean tech, hydrogen. We could spend a whole other hour talking about ESG and sustainability investing, which is also a very fast and even larger portion of global capital markets now than thematic investing. But there's different ways to do sustainable investing, right? You can take the S&P 500 and you can screen out names that pollute too much or build firearms or sell cigarettes. You can do a bottoms up approach to ESG that's investing in really kind of like the leaders in different areas. But there is a thematic approach to sustainability, which is looking at the themes that if they play out the way we expect them to, are going to impact the world in a positive way, whether that's environmentally, whether that's socially, probably not in the government space, but really kind of more in the social and environmental space. We've done some work to see kind of how some of our themes align specifically with the UN Sustainable Development Goals, and like very clearly, renewable energy producers and clean tech are kind of swimming in the same direction as those environmental goals of the UN SDG. What do you do with education though? There is a UN SDG about broadening education. There's a UN SDG for broadening financial services and access to banking. Is that being addressed by fintech? There's even harder questions to answer, like if we want to live in a world of renewable electrified energy, what do you do with lithium mining companies, which on one hand are mining companies and super dirty, but on the other hand are kind of a necessary evil to get to electrified transportation? So we're even earlier in that kind of intersection of sustainability and thematic, but we know there is a piece of this that is kind of sustainable as well as thematic. All right. Well, maybe I'll end it there. Thank you, everyone, for listening. Really appreciate it. Wish we could do it in person. Hopefully next time I can come by to the new campus and say hi to all of you and give you guys an update on what's happening in thematic. But really appreciate you listening, and thanks for all the great questions.